My guest today is Jeremy Harbour. Jeremy is a founder of Unity Group. It's a holding company based in Dubai, which acquires and sells companies. Within the last 20-year period, they've done more than 100 deals. And on top of that, there have been a lot of distressed deals. Thanks a lot for coming to the Holdco Builder show, Jeremy.
Yeah, thank you for having me.
Daniel Priestley was a previous guest on Holdco Builders podcast, and he said that you're the perfect person to talk to, and because you've done so many deals, no money down deals, obviously different structures. So I thought it was a great idea to reach out, and it's awesome to have you.
Yeah, I've done lots of deals for Daniel as well. So yeah.
So before getting into all that, can you take us back to the early days of your entrepreneurial journey?
Yeah, so look, I was the annoying kid at school that was always trying to sell stuff to people. So I saw school as a bit of a marketplace for, to potentially make money. I didn't really get the education purpose of it. That was not really interesting, but the idea of being able to sell stuff to my classmates was quite appealing, and so we'd play around with different things that were in demand, normally things that were against the school rules, like jewelry and stuff like this that they weren't allowed to buy from elsewhere, so I used to bring it into school. And I mean, from there, I actually developed a kind of wholesale trading business. I used to supply market traders with jewelry and watches and stuff. I seemed to have a knack for being able to buy them for less than they could, and they'd often been in this industry for years, and I was a teenager. I had my own little market stall as well at the weekends where I would sell this stuff. So effectively my cost of goods was lower because I was wholesaling to other traders, and then that gave me a better margin myself. Taught me a lot of lessons about buying right, getting in at the right price. The business probably wasn't that scalable. So I started, I kind of accidentally bought an amusement machine, one of these big like arcade machines, and I supplied it to our local pub, and then started buying more of them and dotting them around the place. And at the time I didn't have a driving license, so I had to get my grandmother or my father to drive me to these places to go and do this stuff. And that business kind of that was scalable, and that did grow. And by the time I was 18, I'd left home, and I had like 30 of these machines all over the place. Ended in disaster, but that I was a startup entrepreneur, I guess.
So what was this was the business you started, but what was the first like a major investment, and what got you into investing?
Yeah, so funnily enough, I never associate acquisitions with investment because we structure our deals with, in a very capital light kind of way. So my first real investments came when I sold a company, because that was when I had capital. But I that amusement machine business I had, it failed when I was nearly 20, about 19 years old. And I kind of had a few months of kind of feeling sorry for myself and licking my wounds. And then I got into telecommunications, and particularly in the mobile phone space. Now, this was the mid 1990s, and in the 1990s, mobile phones went through a transformation of being extremely large to extremely small, and the market exploded. So I think I remember reading at the time that the total addressable market for the UK was about 3 million phones. And during the 1990s, it hit 40 million. So they'd completely underestimated the demand. It created all these, great companies like Nokia and people like this that just exploded off the back of that boom. But it went through like an accelerated market cycle in that everything was greenfield. There was nobody had one, so everybody wanted to buy one. So you went through this huge explosive growth, and with that, lots of companies set up. So the market fragmented incredibly as well. So whilst you had these big players, you also had hundreds of thousands of kind of small players. But it then very quickly hit saturation. And so saturation, I guess, is like everybody has a gym membership, and you're just trying to win people from another gym to come to your gym. It's the same thing in the mobile phone space, that everybody had a phone, and all you could do now was go after people that already had one and try and get them to move to you. And that's a much harder exercise. That's like your biggest competitor is apathy, because people couldn't really give a shit who they got their service from. It was just really trying to push people over. And so as a consequence, the market became really, really acquisitive, or really consolidating, because the easiest way to grow your customer base was just to acquire somebody else's customer base, because to go out and do that organically with a sales team was hugely expensive and time consuming. And so as a consequence, a lot of the smaller players started buying each other, and the mid-sized players were buying those roll-ups, and the big players were buying anyone that got above a certain size. And so the whole market was just this sea of M&A. I mean, you've never seen anything like it, and I haven't seen anything like it since. I mean, you're talking, I could have 20 meetings in a week with companies that wanted to buy me if I wanted to. It was so crazy. And but what that did is, I as an entrepreneur, I was fascinated by this because in my mind, the only three ways I could grow my company was through better sales, better marketing, or working, more efficiently with my team to deliver greater results. Now, all of a sudden, there were these people that had created businesses overnight that were bigger than mine, and they hadn't done any of that. They just bought other businesses. And so I thought, obviously, the restriction to me doing the same thing would be access to capital because, I didn't have any money. I was a bootstrapped entrepreneur. Banks wouldn't lend me money because they're smart. They don't lend they don't lend entrepreneurs money. And so I thought that was the reason why I wasn't in that marketplace. And then when I started having these meetings, when I'm sitting opposite these people trying to buy my business, this kind of penny drops that, fuck, they don't have any money either. They're also like basically trying to structure a deal here that becomes self-financing, that has an asymmetric risk profile to it. And so after a few of these meetings, I thought, shit, I need to be on the other side of this table. I need to be the buyer, not the seller. And so I was young. I looked younger than I was. So possibly not the most plausible entrepreneur running around, but I basically ran around and started trying to buy another business. And I was a little bit lucky. Luck, I think, is always an important part in deal making because it takes you down certain paths, but you have to put yourself in luck's way. You have to take the activity that gives you, you have to buy the lottery ticket or you'll never win. But I had a bunch of meetings and I managed to find a telecoms company that had a particular set of motivations. The primary one being that they operated out of a retail venue, and the retail venue was going to be bulldozed and turned into apartments. And so they saw this kind of ticking clock by which time they had to be out of this premises. And so this was a big factor in getting that deal over the line. But basically, I was able to close that deal. I didn't have to put any money in, although that was a bone of contention. They wanted some money up front, and I didn't have any. My choice at that time was pay my credit card or pay my staff. There wasn't a third option, which was give this guy some money. And so my proposal was 100% deferred. His proposal started at 100% upfront, went to 50% upfront, went to 25% upfront. And when the bulldozers are pretty much about to demolish the building, he takes 100% deferred. And I just learned so many lessons from this. The first one was I grew by a year's worth of sales in an afternoon. So what would have taken me a year to achieve historically, we did in a day. I grew my customer base without investing in marketing and without investing in sales, which historically had been a huge cost for us. In telecoms, you pretty much land grab. So you pay to acquire customers. It suffocates your cash flow today, but improves your cash flow next year. And so you're always striking this balance as to how much you're going to reinvest in acquiring more customers. This gave us that boost without having to take that upfront risk in terms of invested capital. And the other thing it taught me was actually this is a buyer's market. The guy that was trying to sell was too small for a traditional buyer. If you look at the traditional buyers in that space, you had the trade buyers, then you had the the search fund style of buyer, and then you have the kind of LBO type of person. Well, an LBO guy couldn't do a deal on that business. It was a service-based business, no assets, and probably a bit small. The search fund guys would be scared to death by it because they can't do a proper due diligence on it because it's owner managed. It's when the guy doesn't turn up, the shop isn't working, and the trade buyers wouldn't touch it because it was too small for them to do a due diligence on. The due diligence would have cost more than the annual revenue. And so what I realized was, despite the fact he was telling me there's a queue of people waiting with a checkbook to buy this business from him, the reality was I was the only game in town, and I had a lot more power in that situation than I thought I did. I thought, shit, I need to find this money, I need to close this deal or else it's going to get away from me. And the reality was it came to me anyway because there wasn't any other choice.
That's interesting that you mentioned the buyer's market, because this would have been my next question. Like, how on earth were you able to do this deal? Because you just previously mentioned that there were so many buyers, so many sellers. Like, how he couldn't find better terms, if we can say that. But I think the same is true probably on a smaller market here in Estonia when talking to business owners. Small business owners, businesses which revenue are less than 10 million,
Yeah,
there is actually no competition
yeah.
on
You'll find that
deals.
you'll find that pretty much globally. So, like I say, the competition is a trade buyer,
Hmm.
and at 10 million, it's interesting to a trade buyer. Like 5 million and below, forget it. They can't afford to put the lawyers and accountants on the deal for that transaction. So the 1 to 5 million space is completely virgin. The 5 to 10 million space, I would say, is like semi-virgin. You've probably got one or two competitors in the transaction. The search fund guys, these are all MBA students. They did their MBA. They learned how Anheuser-Busch bought the second largest brewery on the planet, and they're now trying to apply that to an owner-managed business, and everything looks shit. Because all small businesses are a bit shit, and so they look at it and they go, "Oh my god, I can't do this transaction," and they walk away. Whereas actually, we look at the business and go, "All of these issues that we can see are the reasons we're not going to give them money up front." And they're good reasons why we can negotiate a much better deal structure because it just looks better. And then the other option is the LBO guys. And obviously, the LBO guys have been royally fucked. I hope you don't mind me swearing on your show. But
That's fine. That's fine. That's fine.
they've been royally fucked in the last few years. You imagine if you did an LBO in 2019 and then COVID came along and shut half the businesses down, and then inflation came and massively increased all your costs, then interest rates came and increased your cost of borrowing, then recession came so basically they've just had a proper kicking in the last 4 or 5 years, and they're gun shy. They don't want to do deals at the moment because it's probably the time to do an LBO deal because you can probably get the cost of capital down again over the next 1 or 2 years. But everybody's gun shy because businesses are battered and bruised, and capital's expensive and harder to get than it was. So the LBO guys are kind of out the market for the last 4 or 5 years, particularly in that end of the market, that smaller owner-managed business end of the market. So we really do have almost a virgin kind of territory in front of us.
So we got into the early stages of this telecom company, but how did it go? How was the next 18 months, 24 months? Because this was I guess, like a realization for you that, okay, I can actually buy those businesses by just collaborating, doing some great terms. Like how
Yeah,
it went afterwards.
it was an epiphany in terms of just how you could grow a business. And then consequently, I went and bought a bunch of other businesses. We ended up in 18 months, we went from one company to 12 companies. And we went from about 1.5 million to 13.5 million in revenue. We went from 25 staff to 135 staff. What was interesting is at the beginning of that journey, I was trying to find 2.5 grand to give this guy as just something up front to buy this business. And I honestly couldn't find 2.5 grand at that point. 18 months later, my payroll was 250,000 a month. So from a psychological perspective, it was just such a big shift in terms of what was considered a lot of money, or what I'd seen in the company's bank account at any point in time, just completely changed. So it was like the first domino fell, and then everything else kind of fell into place, because my second deal was actually 2 weeks after my first one. And I swear it was a scenario where in the past, I wouldn't have spotted that there was even a deal in that conversation. But because I was so excited off the back of doing the last one, what is it? To a hammer, everything looks like a nail. I think to a deal maker, everything looks like a deal. So every conversation turns into, can I buy this? So,
Did you partner up with some CFOs or people help you to do the deals, lawyers or something? Or how were you able to do the due diligence and things like that so
well,
quickly?
so
Or
look, the view I took. So when I bought that telecoms company, we were buying it with no money down. The total consideration was only £15,000 that was going to be paid over the next 6 months, and the total revenue was only about £250,000. It was worth a lot to us because we could add their billing to our billing, and there was no incremental cost to us for doing that. But on the basis that, why do you do due diligence? Well, you do due diligence to protect your capital. Well, I'm not putting any capital in. So do I need to protect my capital? And then likewise with the legal fees, why would you hire a lawyer to close a transaction? Well, it's to make sure that you don't lose all your money in the deal. And so from my perspective, I was buying just the assets of the company, and I was paying for them on a 100% deferred basis. So I kind of just took the view that I'm comfortable with that risk, and therefore, I will buy the assets and pretty much figure out what I've got after the event. And likewise with the legals, we just did a letter agreement between us, which was a schedule of assets and an agreement to purchase those assets and the terms upon which we were purchasing them. And I did a very similar thing with the IT company that I bought 2 weeks later, which was basically we just wrote a letter that we both signed, which outlined the assets that we were purchasing and the terms we were purchasing them on. Again, no money exchanged on day one. And there's, the implied warranty around what they're providing for the deferred consideration. So if you did find there was something that they said they had and they didn't have it, then you've got a pretty good reason for not giving them the funds later on. And so, I always looked at, that kind of due diligence and legals piece based on what am I protecting myself against, and then you make a judgment based on the risk.
So how did this story ended? Because the mobile phone market obviously changed. So how did this go?
Yeah, so interestingly, I'd run the telecoms company for quite some time, and I grew by buying all of these other businesses. And I had, from the 12 companies, there were 2 companies that probably derived 70% of the revenue of the group. And one was a call center business and one was the telecoms business. The call center business was growing really quickly and spat off cash. The cash flow model in call center is pretty much you pay someone £7 an hour and you bill it out at £27 an hour. And so the more people you have sitting on desks, the more revenue comes in, the more cash it generates. Whereas telecoms was kind of invest £150 in a customer now, and they'll pay you, £8 a month for the next 3 years. And so the cash flow model of a telecoms company was much harder to grow than the call center business. So I kind of made a decision that I would sell the telecoms company and capitalize on that. And I would keep the call center because it was a cash cow. It just made 200 grand in a quarter, cash, net cash. I bought myself a Porsche. I bought my business partner in that business a Mercedes, and we were having fun as kids, and so that was a keeper for me, And also we had a 3-year contract with the world's largest insurance company, and they kept wanting to get more and more capacity from us, and so this was like an easy decision for me. So it took about 9 months to sell the telecoms company. As you know, buying is quite quick, selling is quite slow. So by the time we'd gone through that sales process, and it was a trade sale, by the time we'd gone through that sale process, the call center had gone bust. So I actually sold the telecoms company in 2006, end of 2006, and the call center went bust at the beginning of 2007 because the world's largest insurance company, which was its big client, was AIG, the American insurance group, who famously went bust in 2007. It was kind of the precursor to the global financial crisis. And so I guess I had a cluster of lessons all in one there. So the first one was on the sale of the telecoms company. You don't make money running businesses, you make money when you sell them. And this was a huge epiphany, because what I'd done prior to that was basically empire build and try and charge fees from all of these companies. So they were all paying me management fees. And so I was in my 20s. I had 12 companies. My income was probably about £17,500 a month. And bearing in mind, this is like 20 years ago, it's probably like 50 grand a month equivalent now, which is a young kid, and all your expenses are paid by the company. You have cars and shit running through the, mobile phones, all that stuff is running through the business. So I thought that was really great, but that's just income. And your lifestyle adapts to your income, whatever your income is. So your lifestyle just grows to fit the income that you have. So you still don't have capital. You still don't have wealth. When you sell a business, you get a chunk of capital in one go. That chunk of capital in one go can be deployed into income generating assets, not businesses, but boring shit. that generates an income that comes in regardless of whether you're working, not working, sleeping, awake, or whatever. And that was a big epiphany, that's actually financial freedom. The financial freedom didn't come from adding more and more businesses and charging them fees. The financial freedom came from creating a capital event and making that capital work for you when you're not working. And so that was a huge epiphany. The other one it taught me was, I think you discussed this previously, was the right time to sell a business. And the right time to sell a business is now. If you have a buyer, sell to them. If you think that, the reason everybody tells, or the reasons people always give me for not selling their business now are the exact reasons the buyer is going to want to hear. So if your reason for not selling now is that next year is going to be your best year ever, well, of course, that the buyer's going to love that. The buyer doesn't want to buy a business if next year is going to be the worst year ever. And this is also why, God invented earnouts. You stick an earnout in there that allows you to capitalize on next year if it is indeed the best year ever. And if it isn't, you don't lose anything. So an earnout is also an asymmetric bet that you make with the buyer, which is, look, heads I win, tails I win. Yeah, I think the right time to sell a business is now. The reason I didn't sell the call center was it had a 3-year contract with the world's largest insurance company. And the reason I should have sold the call center is it had a 3-year contract with the world's largest insurance company. That's the kind of thing a buyer would like to buy. And as it turned out, the world's largest insurance company was bankrupt, but we didn't know that at the time.
So it's so interesting because you're saying that the right time to sell your business is now. But I've had many guests on this podcast who are so-called like buy and build entrepreneurs who buy a business, they fix it, it grows, and then they're not selling it because they kept saying that, why do I need to sell this business in order for me to just go out and look for another one if it's a good business? So what's your thoughts about this?
Yeah, so this is the camp that I was in before. So I had Warren Buffett's words ringing in my ears. The best time to sell a good business is now. And I thought, a shitty air conditioning company in the west of England was a good business. He thought Coca-Cola or Apple were a good business. And so my definition of good business versus his definition of good business were obviously miles apart, but I was making a false equivalence by thinking that these shitty small businesses are, great companies. And, they might have some barrier to entry. They might have some unique product. But again, they're all things that the buyer is going to want to hear in order to buy the business from you. And as I've kind of proven again and again, things change quickly. You can have your industry disrupted. Amazon could get into your business. Google could get into your business. AI could transform your business. And small to medium-sized businesses are incredibly volatile assets. If you lose 2 key customers or 2 key staff members, the dynamics of that business change dramatically overnight. And so when you capitalize on an exit, you have this capital. And honestly, in most cases, the capital that you generate, you can make more income from that capital than you could take out of the business realistically, because the business needs some working capital left in it. If it's making 500 grand a year of EBIT, you can probably only take 150 to 200 grand of cash out of it realistically, but you could probably sell it for a couple of million. And for a couple of million, you can easily generate 150 to 200 grand of cash without having a business that you have to visit, that you have to attend board meetings, that you have to deal with management, staff, customers, all of those things. And so for me, I think, from a lifestyle perspective, you don't want to be a business owner. You don't want to be a business runner. You want to be a business owner. You want to treat them like assets and sell them, buy them and sell them. And the money is made when you sell them, not when you're holding them.
So a few things we covered. It's a buyer's market. So obviously you've bought a lot of businesses, but then as you're saying that the best time to sell a business is now. So you've sold a lot of businesses. How easy or hard it is to buy from you? Because you are this wealthy guy. You are like, okay, I don't need to sell the business if I don't want to.
Yeah, I think, look, there's kind of 2 halves to my journey. There's the half when I was buying and selling these companies, which was a lot of distress deals and small businesses. And now what we tend to do is acquire companies and flip them into public companies. And they're typically companies that we took public in the first place. And we're then using those as an engine to acquire companies. Now, in the first scenario where I was buying and selling businesses, I would say I was the best vendor ever. because most vendors are emotionally all wrapped up in their business and emotionally wrapped up in the price that some dumb broker told them they're going to get for their business, which just ends up stopping them from being able to sell the business. I would be pragmatic about the valuation, pragmatic about the deal structure. Plus, I would have all the shit together that you need to show a potential buyer. Whereas, when you go to a deal that a broker recommends, they don't even have a data room that's ready and up to date with the right information in it. They're still running half their personal expenses through the company. They've still got paper-based systems that aren't documented. So all those things that a buyer needs to see often just don't exist in a broker represented sub 10 million revenue company. So by having all of those things, you're immediately in the top 1%. And you've probably heard this statistic that only about 10% of businesses actually sell that are put up for sale. And it's basically because the other 90% are not sellable. They're not in a position where they could survive a due diligence or survive any kind of scrutiny. And so if you have one that survives scrutiny, then there's always a deal to be done. And it just comes down to price and structure. So, and being that we often got in a very capital efficient way. So we've used the business to finance the business. So then when we sell the shares, if we sell the shares for anything, we're up. We're in a bought right is half sold, which I kind of learned when I was selling stuff on a market stall as a kid, and translates very well into business as well.
So those sub $10 million dollar businesses, how do you find them? How do you build the pipeline? If you said you prefer maybe not using brokers.
Yeah, never brokers is basically the mantra. It's the whole broker industry. I mean, it's very ripe for disruption. I mean, if you look at the least trusted people in the 1970s were secondhand car salespeople, and then probably estate agents after them. In terms of levels of trust. And if you look at both those industries, they've been completely disrupted with, you buy your cars online now, you do your house searching on, Zoopla or Rightmove or something like that. Business brokers are now the least trusted professionals out there. And so just, it's horribly unregulated. They make promises that are completely undeliverable. They charge fees where there shouldn't be fees. The whole marketplace is a mess. And the problem is business owners don't sell a company very often. So the first time they do it, they buy into this bullshit. You've got a smooth talking, suit wearing business broker who probably used to be a secondhand car salesman, who's telling them they're going to make 3 million quid from their business that does 50 grand a year of profit. And they buy into that. And so that makes that market very difficult to do much with. But if you just outreach directly to business owners, and, we've done this with letters, with LinkedIn outreach, it's very easy to narrow down your sector. I think people get obsessed with paying other people to do things, but actually when you do it yourself, it's not an expensive or time-consuming exercise. You can pretty much create a list of everybody in your marketplace, or you can go through a trade association, depending on what industry you're in, and then just go down that rabbit hole. And pretty much as soon as you've done a deal in that sector, your credibility goes from 1 to 100. And so as soon as you have a deal in that sector, you'd be amazed how many other deals come out of the woodwork. They'll reach out to you on LinkedIn. They'll reach out to you by any means to see if there's a possibility for them to do that kind of transaction too. And so,
2 weeks ago, I had on a podcast Nigel Lee from Australia, and they bought I think 10 plus companies within the last 2 years. Mm-hmm. But what they did, the best deals they found is by contacting small accounting firms, 1 to 2 person accounting firms, because they have this trust, this relationship with those small businesses.
Yeah.
And this way they've been able to buy businesses. The average acquisition multiple has been 2.5 times. Mm-hmm. So it's been quite remarkable.
Yeah, no, I think I've never been a fan of intermediaries. I think you can go direct yourself and you can do stuff. And I mean, look, I have a community. Some people on your podcast probably have heard of the Harbour Club, but the Harbour Club community, we have so many people doing deals in different ways. And, some people do content driven stuff. So they're posting constantly on social media about the industry that they're looking at, and that creates an inbound funnel. Other people joint venture with other people who have deal flow in a particular area, and others just do the cold outreach. And I would still say most of our successful members are cold outreach. And I would say it's mostly letters, and the balance is LinkedIn. LinkedIn outreach has worked really, really well in the last 2 to 3 years because pretty much everyone you're looking for is on LinkedIn.
Okay, so we are in between with your journey. I think we are now in year 2008, 9, or 10. What was going on next, and how was the early 2010s for you?
Yeah, so I think I sold a business, lost a business, and then kind of stood back and looked at everything and thought, okay, what are the lessons that I can learn from this? And like I say, the key epiphany was buying businesses is quite easy. Selling them is a little bit slower, but you only make your money when you sell them. So let's focus on that. The things I didn't enjoy about business was the staff and the customers and dealing with that day-to-day operational kind of bullshit. And so I decided to focus on buying and selling companies and just picking them up and selling them. And as it was 2009, I figured, well, let's focus on distressed because I'm not going to have to put any capital into the deals. I can pick, distressed companies up for £1. I've run lots of distressed companies because a lot of the startups I did got into all sorts of trouble. So I know how to fix quite a few problems. Other people would have been overwhelmed and quit by then. So I think I can deal with some of this crap. And so that's what I did. I just focused on, I sold off the balance of my portfolio, either back to the business owners themselves. So in quite a few cases, I sold to management. And in a couple of cases, the management was the original founder of the business. So I ended up exiting all the kind of positions that I already had. And then my starting from scratch with a clean sheet of paper was just to buy and effectively flip, but it was buy and sell. And some things you'd hold a bit longer, some things you'd be able to sell a bit sooner. But I focused on the kind of distressed area. And of course, in 2009, everything was distressed. In fact, it's how I ended up doing more business with Daniel Priestley, because I'd met him once at that point. He'd had somebody call him and say, would you like to buy our training business for 300 grand? And this training business was doing about 3.5 million back when Dan was probably doing 1.5 million. So it was a much bigger competitor in the same space that he was in. And he kind of looked at it and thought, should I give them 300 grand or should I spend 300 grand out marketing them? I'll spend 300 grand out marketing them. So thank you. But instead of saying go away, he said, but I do know this guy, Jeremy, who buys and sells companies. And so got them to call me, and I bought the business for £1. So I ended up being twice Daniel's size. He'd been going for like 5 or 6 years. I was suddenly twice his size in an industry I knew nothing about, that I'd only just walked into that afternoon. And that was when Daniel said, shit, I need to understand what it is you do exactly, because I only said to call you because I didn't want to speak to them. It was not because I thought you could buy it for £1. And so actually that was the kind of genesis of the whole Harbour Club thing.
How was the structure?
It was literally £1 for 60% and then 40% on an option at the 300 grand. On the basis that the business wasn't sellable. There was loads of issues with it. And so the idea was, well, we'll take 60%, we'll fix all of those issues, and then we'll buy the balance off you out of the profits that the company would then be making. So you get your 300 grand, but you just get it after we've fixed everything. And the owner was based in Australia. The company was in London. And so they didn't particularly want to be on a plane, every month coming back to try and fix these issues themselves. Plus they'd had loads of problems with management. Their biggest problem was their sales director was Australian, so they trusted her because they were Australian, and so they promoted her to finance director, but she had no financial qualifications at all. And so all of the finances, every whatever button you pressed on their accounting system just spat out complete nonsense. So you could see the revenue through the bank statements was like 3.5 million, but nothing else beyond that made sense. It was a bit messy. It was a distress deal.
So after that, once you did that, you again, eye-opening stuff for you. did you keep doing the distressed deals, or you moved into more
Yeah, so
traditional?
I mean, we luckily in Europe the kind of the recession lasted a bit longer than the rest of the world because we had this European debt crisis in like 2014 or something like this. So it kind of dragged out the global financial crisis a bit more. But yeah, by like 2015, pretty much, the heyday of distressed had disappeared. The companies that were going to go had gone, and what was left was a bit more robust. And then we kind of spotted the opportunity that we were coming across a lot of really good companies that didn't have many options. So typically companies that were doing 500,000 to 1 million in EBIT every year, so they're profitable, but they can't get money from banks because post-crisis the banks wouldn't lend any money to anyone. They couldn't get money from VCs because they were boring businesses that made money, whereas VCs were looking for, gambles basically, or things with a really, really high upside that they could put their money to work in. Private equity is not interested because they're tiny. So these were great businesses, often more than 20 years old, with kind of nowhere to go. And so this is where we started to look at capital markets as a possible solution for them, which is why not do a roll up in the capital markets, create shareholder value that way. And that was really, and the first listing we did was in 2016.
What are the typical characteristics of such businesses? When you
Um,
have people
Yeah,
send
so
you lists of.
we tried to look at an average, and of course, there's never an average because there's always outliers. But typically, they're more than 20 years old. They're more than 1 million of EBIT. The management actually are not particularly exit focused. The management would like to continue growing the business, and they just can't figure out how. They've often hit a bit of a glass ceiling, and possibly for like a decade of glass ceiling, and they're trying to figure out that next step. And so when we talk about going public, they see the opportunity that they can now pitch for bigger contracts. They can get government contracts. They can attract better talent and better staff because as a public company, they have more credibility. And they can do acquisitions because now they can issue stock or bonds as part of the acquisition consideration, which you can't really do in a private company because your stock or your bonds don't have that much value. Whereas if they're listed on a regulated exchange, they have potentially more value and therefore easier to get those kind of deals done. So it's really approaching people that see it as a platform to grow. And this is a little bit counterintuitive because if you ask most people, what does an IPO mean to you? They'll nearly always say to raise money or to exit. And it's a terrible way to raise money and it's a terrible way to exit. So it really is a platform for growth. And if you look at the richest people in the world, they made their money going public and then using it as a platform to grow. So if you look at LVMH, Bernard Arnault, went public, used that as a platform to grow and acquire everything on the planet. Elon Musk took Tesla public, completely transformed that business. Meta, Facebook, whatever you want to call it, Microsoft, Berkshire Hathaway. The list goes on of entrepreneurs that are still involved in their public companies, but use them as a platform to grow, not as a way to exit.
What are your thoughts when it comes to focusing on this one specific industry, just expanding there, keep buying the competitors, and maybe doing going public so you could expand even more? Versus what you've done is you find an opportunity, you pretty much sprint, you fix it, and then you sell it, and you make this liquidation event pretty much.
Yeah. So capital events are the key to wealth and the key to lifestyle as well. I mean, the one thing people don't consider when it comes to exit is it's not just the money you get, it's the time you get back as well, because you don't have to focus or think about that business anymore. You're released, so you can go and do a lot more. And I've always had a very finite view of life. So when I was a kid, lots of people around me died. My grandmother was one of 14 children and she was the youngest, so all my uncles kept dying every year and I'd be going to lots of funerals. My older brother died when I was 10. 2 people at school died. It was amazing. I think by the time I was 15, I'd probably been to like 30 funerals, and then I'd speak to 30-year-olds that had never been to a funeral. And so I realized I possibly had an unhealthy exposure to death as a kid, but it made me think in very finite terms about life. I didn't go and do A-levels after school because I just didn't want to waste that time. It was 2 years. Like, fuck, why do I want to do that? It's only gets you into university, and I don't want to go to university either. So, let's get fucking started. Come on, like, what are we doing? So it gave me this very finite view. And I remember always thinking about the kind of useful lifespan thing, which is kind of your first 20 years, you're still figuring shit out. The last 20 years is, getting up 3 times a night to pee. what's the gap in between? You know, if you take the first 20 and the last 20, what's the gap in between? If you're really lucky, it's 40 years. So if you spend 10 years or 20 years building one thing, that's a quarter or a half of your really useful life that's been invested in that one thing. And if you didn't get that one thing right, if that wasn't the right path to go down, that's a huge commitment. And so, yeah, I just looked at things, I guess, a little bit more urgently in terms of what's the best way to have the best lifestyle and not to be immersed in something for 10 or 20 years. And by the way, I was in the telecoms company for 10 years. And that was where a big kind of epiphany came to me, because I think 5 of those 10 years was actually building value in the business. And probably 5 of those years was not, in terms of we didn't particularly grow or take big leaps forward. And so only half that time was really valuably used, if you like, in that business.
That's so interesting that you mentioned the lifestyle part, because I think a lot of people, I think 5 years ago I made the same mistake. I wanted to do things because it looked cool for others, for folks I don't even know. And it was great to tell some stories that this is what I'm doing. But now, as you just said, life is short. I'm 31. I've been in, I don't know, I think 2 funerals. One was very close person. The other one wasn't that close. So I have a bit different story than you. But I think, yeah, what you said is so interesting, because you do what you want to do. Even though you have the skills and capabilities of building this huge conglomerate of holding company, you prefer to do these quick deals, make the money, move on, find another one. Maybe there is a 6-month pause between 2 deals. I totally get it. Totally get it. And I respect that.
No, and look, lifestyle is really important. Like, you have young children, or you have young child about to be children. By the time people watch this, maybe children.
Yep.
But I have a 9-year-old and a 7-year-old. I'm really proud of the fact that I've been able to spend every day with them, pretty much. In terms of their growing up, apart from holidays and stuff like that. And also, me and my wife love to travel, and we travel pretty much every month. And this month it'll be twice. Last month it was twice. And so, we're able to have that lifestyle because we're not tied to an office job or a business that we have to turn up to or do stuff in.
Yes, because at the end of the day, listening your story, you are winning in life compared to some other guys who are building maybe very large companies. I don't know if they're on a Forbes list and stuff like that, and they are miserable because no time for kids. They're busy. I've heard stories like this as well. Thanks to Twitter, I met few of those, and those people have said to me that I don't even know why I'm doing this, but I'm not happy. I'm not happy, even though there's all the money in the world, but there is no this call of freedom of what you can do, pretty much. And one thing for sure is spending time with kids. Now I see what you mean. 3 years ago, I would say, I don't know what you're talking about.
What's the point of that?
Yeah. Okay, a little bit about the business more. I want to know the post acquisition. You do those deals. Next day you go to the office. What do you do? Is it the checklist you go through, or what's going on? How you fix those businesses?
This is kind of career in 2 halves. So in the first half, I was extremely active in the businesses, and now I never turn up. In fact, I think if I went to some of the businesses I own right now, they wouldn't know who I was. They might do, but generally, I don't think they'd know who I was, apart from maybe the senior management. And in the early days, I mean, all the focus I used to put was around cash flow. Because I did distress deals, businesses don't go bust from a lack of profit, they go bust from a lack of cash. And so a lot of the things that I would put in on day one were all cash flow focused, cash metrics, cash flow focused activities. And then the other thing was just basic financial engineering. So small owner managed businesses tend to not be audited. And so they don't have an auditor scrutinizing their kind of accounting treatments that they use within the business. And often they're positioned to save tax, not to show profit. And so by changing the recognition of revenue and recognition of profits, actually to be more like a public company. So if you take the accounting treatments of a public company in the same sector and apply them to a small business, you'll often find that the profit goes up quite considerably because they're now showing everything rather than hiding stuff. Now, this comes down again to positioning for sale versus rolling up a group, because obviously you create tax liabilities in the business, but you also increase the value of the business, or certainly the ability to justify a value. And so, that would be the main things, would be the kind of financial engineering of the financial treatment. So recognition of revenue, recognition of cost, capitalization of investments, and all those kind of things that would increase the profit and the balance sheet value. And then cash flow stuff. So how to make this thing spit off more cash using the same numbers that it already has. Nowadays, we just let the current management team get on with it. We will obviously take them through an audit process and a systems process that drives the audits, because as a public company, reporting is, first, second, and third priority. But beyond that, in terms of the actual business management, they've been running this thing for 20 years. They know their industry. We're happy to let them carry on. And we take the kind of Berkshire Hathaway view, which is if they do next year what they did last year, that's a raging success. We don't need them to hit it out the park or double their business overnight. We just need them to carry on doing what they do.
If you can share, how does the portfolio look today, and what industries, what niches, what you're doing today?
We have a number of groups that we've either taken public, or that we are taking public, or that we're reversing companies into. So we've got one in the education space, and it's predominantly the kind of government funded kind of education. So things like apprentice programs and those kind of businesses. We have a clean energy group, which was actually like a tech incubator that we took public, and we're now acquiring other projects into that. We have a sports media company, which is a US listing. It's doing a lot of stuff in the mixed martial arts and fighting tournament space, which is a huge kind of addressable market. But we're also buying other sports media businesses into there, like production companies, TV channels, that kind of stuff are being acquired into that group. We have a group of franchise companies, so franchisors. So we buy franchisors, expand the management of that company, then expand them into other territories and grow them. There's lots of kind of stagnant franchise brands, I guess is the right way to put them. So they acquire those, breathe new life into them. We don't. We just focus on the acquisition side of things. What else is there? There's a group of facilities management companies that we're just in the process of taking public at the moment, and that's quite a big group actually. But it's a lot. It's not only the FM provision, but it's all the services that sit around that as well. So the actual service providers, and there's lots of people building groups in that space, particularly like in M&E and HVAC and things like that. It's again huge fragmented market, easy to do deals. Low multiples, cash generative. So it's quite an easy space. They're the ones I can think of off the top of my head. There might be a couple I've missed, so I apologize for anyone that's watching that's in one of those ones that I've forgotten.
That's fine. You've been in this game for a long time. Cash flow is king. Is there any companies you bought long time ago, but as it runs automatically, there is a team in place, management in place, and you thought that okay, let this thing just grows, and even though it's stable, and you thought that okay, it's not good idea to sell it. Has there any companies like this on your portfolio?
And actually the two that spring to mind are both ones I regretted not selling. So one of them was the call center business I already mentioned, had this 3-year contract with AIG, and it was just growing and growing and growing, and it was run by a great CEO, and everything was fine until AIG collapsed. And it turned out our exposure to that one client was too great, and that was the kind of the issue, but it wasn't immediately obvious just looking at it from the outside. I probably would have made that mistake again, which is always a good test. And then actually there was another one, which was a training company, and they had all blue chip clients. So Tesco's, RBS, NatWest, local councils, local government, like all blue chip clients. Many of those clients it had had for several years, and just looked like a really good, robust little business. And actually, again, that suffered in the global financial crisis because training is a discretionary spend. And all of those companies, I think we did, a couple of $100,000 of revenue in Q4 2008, and we did $5,000 of revenue in Q1 2009. It literally evaporated, and even contracts that had been signed people were just saying, we're not going to do this. You can sue us. If you sue us, you'll never have us as a client again. But we're not going to honor this contract. We've got to cut costs. We've got to get out. And so that was really tough in that particular period. But both of those businesses on paper were keepers. And look, if you look at the black swan in 2008, 2009 was the global financial crisis. What's the black swan today? Is it China invading Taiwan? Is it Israel having a war with Iran? Is it a NATO-Russia clash? Is it a collapsing dollar because of all the debt in the US? Is it a civil war in the US over Trump and Kamala Harris? Actually, there are way more black swans in flight today than there were in 2007. In 2007, everything looked fucking perfect. And then out of left field, this thing no one thought of completely wiped out the economy. And today we can see 10 things that would wipe out the economy. And it might be none of them, or it might be all of them, or it might, but to be so bullish as to say, yeah, no, I can keep this business, it's going to go on forever, I think is just naive. I think you always have to hope for the best, prepare for the worst.
So a little bit about the fundraising and financing of those deals. I'm sure there have been some larger acquisitions you have done and raising additional capital. So what are your thoughts about building relationships with investors, staying in touch, and then once the right opportunity comes on your table, you can reach out and
look, do you know what? It's the thing I've always been terrible at, was raising money, and that was why we put so much focus into how to do transactions that didn't require capital, because actually it was easier to negotiate a capital light transaction than it was to raise the capital. So it was always an area of weakness for us. And then obviously when we got into public markets and taking companies public, there's kind of a well-trodden path of doing pre-IPO raises and following on from there. And so we went down that well-trodden path because it seemed like the logical thing to do. But actually, it's a massive pain in the ass because small cap companies are incredibly volatile. You don't want to be a small cap company, basically. So the longer you are one, the more stressful and painful it is. And so we actually ended up creating initially like a private debt fund. And we've now turned that into a full regulated fund out of Singapore. We call it IPIN, IPIN. And it's basically a fixed income fund. So whilst the underlying investments are small cap public listings, we take the volatility away for the investor. And so it pays a kind of risk-weighted premium on their capital. So they make 15% a year and we pay every month. So it's a monthly payout. But the underlying activity is funded through small cap listings effectively. So reversing companies into public companies and selling the stock to meet the obligations. So effectively, what we've done is we've given investors exposure to the small cap space and to the SME space, which a lot of people don't have in their portfolio, but we've taken out the volatility by giving them the fixed income kind of variance. And of course, some people always say, well, I want to try and capture the upside, but they're also the same people that don't want to see any downsides. So the fixed income works better. And that's been a game changer for our business because it's much easier to get institutional capital. We've already had an insurance company and a large real estate fund invest in us. It's much easier to get institutional capital on board where they can see, okay, we have the exposure to the asset class, we have the exposure to a team that's been doing this for decades and knows what they're doing, but we don't have the exposure to the volatility of that space, which is a little bit scary.
I mean, you've done so many of those deals and the returns, I'm sure, have been extremely good. So there are a lot of people would like to throw money at you. What are your thoughts? And at the same time, you're this lifestyle and family guy and the deal guy. Have you ever had this idea of putting together like a huge fund and doing on this on another level?
Well, so look, I understand where my limitations are, my usefulness, and my usefulness is actually at the pointy end of the deal. So actually getting the deal across the line. As soon as that conversation has been had, my team in Singapore have to pick up on the due diligence, the legals, the auditing, and all the stuff that's necessary to take the company public. So we have a team of people who, I mean, we look like a boutique investment bank from the outside. And there's probably 2 or 3 people in the organization that can do what I do in terms of those upfront pitches. But obviously, it's the bit I enjoy is actually closing the deals. And so what I've done over the years is basically remove myself from any of the other stuff. So I pretty much just focus on speaking to business owners, and that might be sometimes it might be 3 or 4 in a day, and sometimes it might be 3 or 4 in a week. But that's pretty much all I do now is speak to those business owners and bring them into our pipeline. Our pipeline's over 100 companies at the moment that are in various stages of preparation to go public. And so I just have to keep feeding them into that pipeline. Some of them will fall away, some of them will go public, it just drops into a process. And so that fits really nicely around my lifestyle. I often joke to people, actually, vacations are a great way of closing deals, because the second you get on a plane to go somewhere nice and warm and sunny, somebody rings up and says, "Okay, we're ready."
Okay.
That's my excuse.
Few things I wanna cover. I found this on your previous podcast you did when I was doing research. You have said doing more of what works, and this is exactly what you've been doing for past 15-20 years. What are your thoughts about this? And I'm sure there are people who, for some reason, they don't learn this lesson ever.
Yeah, I think look, economics is about equilibrium. Yeah. So when something is a little bit too easy, people pile into that space and it becomes equally hard. So business becomes equally hard over time. And occasionally you find a glitch in the system, an opportunity where there's a mispricing or an opportunity to perhaps make money more easily than should be allowed. And I think when you find those opportunities, you need to really double down. An old friend of mine years ago described it as putting money in slot machines. So he'll go along putting a coin in each machine, and then he finds one that pays out and he puts all the money in that one. The idea, I think, is lean into the stuff that's working. And I think too many times people, stick the bucket down the well, they pull it up, they're so excited they found water, they forgot to put the bucket down the well again, and it's like they run off all excited with the deal that they've just done, instead of going back and saying, what did I do last time? Can I do it again? Is there another opportunity like that? And repeating, basically.
Your thoughts about joint ventures and the beauty of it?
Yeah, I mean, look, business is a team sport. So, and certainly the ability to build relationships and the ability to collaborate with people is an essential skill in deal making, because ultimately, even the buyer-seller relationship should be a collaborative relationship if you want to get a deal that suits everybody over the table. And I think too many people treat it as them and us, like a battle, like a war or something. But actually, if you can collaborate, you can come out with a much better outcome. If they understand what you need and you understand what they need, then everybody can do a better deal. And joint ventures are really just utilizing somebody else's experience or network or things that they have. And so I guess the most common joint venture I do is where people bring me deals. So they find a deal, they're perhaps not confident that they could maximize the value from that transaction, and so they just partner with me to get it done.
A few last questions before we wrap up. You've said you treat companies as products. You buy one and then you sell it.
Mm-hmm. Yeah, I think that's just a shift from kind of customer value to shareholder value as an entrepreneur. It's moving up the food chain in terms of what you do. And so instead of thinking about the products that the company sells, you think about the company as a product. So, who's your best customer? Your best customer is the person that buys your business from you. How do you make this thing what they want to buy? So have your customer focus around who's going to buy your company rather than who's going to buy the product. They should have figured that shit out years ago. Who's going to buy the product?
Okay, so what motivates you today, and what do you want to accomplish next?
Yeah, I mean, look, I'm a deal junkie. So when people ask me what my favorite deal is, it's always the next one. I really do enjoy solving those problems that perhaps other people haven't been able to solve. And, as we've already discussed, I'm also quite lifestyle driven. I want to, make sure that I have fun while I'm doing it. I'm not going to do something that I don't enjoy or doesn't add to my enjoyment of life. And look, I really love hanging out with people, and I love talking about deals as well. So, don't get me wrong, that's also part of the enjoyment is it's terrible pillow talk. My wife is not interested at all. So having people that I can speak to about it is also quite nice.
A question I always like to ask, how has entrepreneurship and building Unity Group changed your life and changed your family life?
Yeah, I mean, dramatically. I think, like I say, when I was younger and empire building, I was emotionally, physically, everything invested in the business, completely living the business. When I discovered deal making, and also when I discovered that I'm not as valuable to these businesses as I thought I was, that all the time I was investing in them wasn't really being repaid. It wasn't accelerating the sale process or adding huge amounts to the sale value. As soon as I had that kind of humility that I'm not as important as I think I am, that was quite transformational, because now I realize I can do a lot less and achieve a lot more by having all of that time available to me. When you have time for opportunities as well as time for your family. So by creating the time in the first place, it opens up a whole myriad of doors. I honestly feel like the busiest times in my life were the poorest times in my life, and the time when I had the most time available to me was when I made the most money.
Okay, let's wrap up with the famous five. How old are you?
50.
Favorite book?
That's a tough one. So Daniel Priestley says the book that changes your life is the one you write, not the one you read. I like that statement. But if I have to pick one, I'd say King of Oil, Mark Rich. If you haven't read that, that's great.
What car do you drive?
I've got a classic Dubai collection. I have a Rolls-Royce Ghost with a driver. I have a Lamborghini Urus and a Ferrari Portofino. I have to have back seats for the kids. So
this is an awesome collection. I always ask this question. This is top three, man. This is top three, honestly. What's the best investment advice you've ever got?
I'm a big believer in investing in passive income generating stuff, which makes my portfolio look like an 80, 90-year-old man. But I do like the whole sleep well at night and have income coming in regardless, because it makes you quite fearless in your other transactions, because you know that you're not going to starve. So yeah, not taking bets on capital appreciation, but taking bets on cash flow.
Okay, so there's definitely a lot of people wanting to reach out, because you are obviously mastered the art of doing deals, but in my opinion, more importantly, you are this happy, relaxed 50-year-old guy who travels the world, drives nice cars, and lives an awesome life in general. So where can people find you if they want to ask more?
Yeah, if they want the business stuff, Instagram is probably a good place. So if they want to see,
Okay.
I post videos regularly on Instagram, just little tidbits, mostly about closing deals or finding deals or doing stuff to do with deals. I think I'm Harbour.Jeremy. It's the one with the blue tick. So if they're trying to sell you crypto, it's not me. So it's, look for the one with the blue tick. That's me. And if they want the lifestyle, if they want the cars and the holidays and the stuff, then follow my wife, Simona Harbour, because she's always she's posting what we do with it. I'm posting how to get it.
This is funny, and I believe she's more famous, I guess.
Yes, she has maybe 20 times as many followers as me. So
okay, this is what
people
people
are way
like.
more people are way more interested in how you spend.
Yeah. Okay, Jeremy, so much fun. It was awesome 65 minutes. Thanks a lot for doing this.
No problem. Lovely to meet you.